Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is Your Course to Retirement with Grand Rapids resource for a common sense approach to planning, helping to uncomplicate and clarify the financial, the investment, the retirement planning world. Certified financial planner Ron Corser here with us, president, founder at Cornerstone Retirement Partners, and Cornerstone serves Grand Rapids area savers and investors, helping you to achieve your important financial goals. Ron, we always appreciate your time. This weekend, it seems like we've got a little less of it. Daylight savings time hit us, and less daylight to try to pack in more stuff, it seems like.
Yeah, my daughter told me one time, she said, "Dad, time is like a roll of toilet paper. The closer you get to the end, the faster it seems to go."
It does.
So
it does.
I always think about that, particularly when you're getting close to the end of the year. We're going to have a really informative program today. We're going to talk about taxes. Now, why would we do that? Here it is. We're coming into the Thanksgiving season and the Christmas season. And, from my point of view, we got a lot to be thankful for. And out there, try not to get too steamed about some of the things that perhaps are not working the way you want them to. We all kind of obsess about that, but we're moving into a time here where we can be thankful to God for what he has given us in our blessings. But then we also have to deal with the man. Put that in quotes, the THEMAN, the man. And the man demands at the end of the year that we pay some more in taxes. So we're going to talk today about, hopefully we'll get through a lot of them, 16 smart tax moves people can make. It's not too early, ladies and gentlemen, to start to think about, can I make some moves? Can I do something now to minimize my tax issue? Or more importantly, to take advantage of some tax things that are going on and prepare myself for next year. Because that's really what we're trying to do here. Figure out how we can take advantage of the tax rules today and take advantage of what they are going to be tomorrow, thinking we know a little bit about that. So we're going to talk about those kinds of things. And I encourage everybody, if you have questions, to give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put in your name, your questions. Be more than happy to help you. Now, I'm not a CPA. We don't, at this point in time, do tax returns, but we do know the tax rules and tax laws. For example, I've been affiliated with the Ed Slott IRA Help Group for, close to 18 years, something like that. So we do know a little bit about what we're talking about, and it is possible for folks you still have time to take advantage of some things. That's what we're going to talk about today. Smart tax moves for 2021. Give us a call, 616-301-2581. Go to our website, www.cornerstone-rp.com. Put in your question. We'll get to you as quickly as we can. So let's move forward.
Absolutely. Well, Ron, I want to just once again repeat the phone number, ladies and gentlemen. If you've got questions, give a call to Cornerstone Retirement Partners, 616-301-2581, 616-301-2581, and repeat the website, cornerstone-rp.com, cornerstone-rp.com. Those are your resources, ladies and gentlemen. And I want to rethink, Ron, a little bit of the way that we have traditionally been taught to think about taxes, because if we are making moves to minimize our taxes this year, or by the time we file those taxes for what will at that point in time be last year, if we're trying to minimize for 2021, there are certain things that we can do to reduce that bill that won't cost us later down the road. But the majority of the moves that we have been taught to take to pay less in taxes is kind of historical and hindsighted and looks back at the previous year or the current year, and then does not think about the future implications of that. And in fact, for many Americans, the way that we have saved for retirement specifically has put us in the highest potential taxable situation on those retirement dollars. So can we give a moment and a little bit of a nod of the cap to the change in paradigm that is going on and the way that we're strategically planning for taxes for a moment?
Yeah, and it's interesting because we got a new client this past week, and I had to interact with the CPA. And one of the things he talked about was a Roth IRA account. Now, I've been doing this business for a little over 26 years. And when I first got into the business, it was beat into me. Tell all your clients to pound as much as they can into their IRAs, 401k, 403bs. Do as much tax-deferred investing as you can, because when you retire, you're going to be in a lower tax bracket. Now, 25, 26 years ago, that idea made a lot of sense. It really did. And I encourage a lot of people to do that. But what's happened in recent history? Taxes have gone up, although right now we're in the lowest tax environment we're probably going to be for the rest of our life. But we know, based on what's going on down in Foggy Bottom, Washington, D.C., that taxes, what we pay in tax, is going to go up. It doesn't matter if the politicians tell us they're not going to tax anybody that makes less than $400,000. I'm here to just say, please take that with a deep breath and pretend it makes sense, because there's a lot of things that can happen. One of which is they can just change the brackets, and they can claim that they're not changing taxes for anybody making less than 400,000, but in fact they are, just by manipulating the brackets. So we're going to go into a time, I think, it's just my opinion, where we're going to be in an increasing income tax world. So what do we do about it? We've been taught all along, put as much away on a tax deferred basis in your IRAs, 401ks, because you're going to be in a lower tax bracket. Let's assume that that's not exactly accurate anymore. And going forward, the brackets and what we pay in real tax, our real tax rate, is going to go up over time. So that simply means for every dollar now that you put in to your 401k, your IRA, get a tax deduction. And remember, you don't get a dollar for dollar reduction. It's just, you get a reduction in whatever you're paying your real tax rate. So what we're doing now is really creating a bigger tax burden for us going forward. Because right now, let's assume that somebody's going to pay, you put $1 in an IRA or 401k, and maybe you're going to pay 10% for the feds and 4.25% for the state of Michigan. Generally, people's real tax rate is a little bit lower than that, but let's just assume that every dollar you put in your IRA, you save 14.25%, or for every dollar, $14.25 in tax right now. So what would happen, say 3 years from now, 4 years from now, when you have to go get that dollar back out and the tax rates have gone up? So instead of paying 10 plus 4.25% for the state, maybe now it's just gone up to 20%, So you save 14.25% going in. Now to take that dollar out, you have to pay 20% or 20 cents of that dollar to the government. The question then becomes, was that a good deal you made? And you can argue that back and forth. We got a brand new client this past week, and I had to talk with his CPA, because we do that. I don't want to make decisions without conferring with the advisors that he had. And I joked with him and I said, no matter what you do, the client always does whatever the two people tell him to do, the lawyer and the tax person. It doesn't matter what anybody else says. They're going to do that. His position was these people didn't have children to leave money to. So why should they do more tax planning with Roth accounts? They already have some Roth accounts. I didn't step into that landmine. I just said that they assume they're going to live another 20 or 30 years, and tax-free money down the road is important to them. So one of the things we can do right now in the next 2, 3, 4 weeks is take a look at how you're saving in your retirement accounts, IRAs, 401ks. And perhaps it might be appropriate for you to fully fund these accounts. Number one, to get a tax deduction if that's important. Or number two, to fully fund a Roth account if you already have one, to put more money in. We'll talk about the limits in a minute. Or put more money into a Roth 401k if your employer has that option for you. So what are the limits? You know, if you're under 50, you can put $6,000 into an IRA or a Roth IRA. Now you can't do $6,000 in each. You have a total of $6,000 to figure out where you want to allocate it. And the important thing to understand is you can put money in an IRA account, either Roth or 401k, even if you're contributing to a company plan, a 401k, 403b. There are some income limits that you have to be aware of, but particularly on a Roth deposits, they're very, very high for singles and couples. So that's one way you can look and say, I have an opportunity to reduce what I'm going to pay in tax this year by fully funding or funding more an IRA or putting more money into my employer-sponsored plan. Or I can do more down the road planning by fully funding a Roth IRA now, or putting more money into a 401k Roth. Or even if you don't have a Roth, ladies and gentlemen, it's still okay. You still have some time to convert some of your IRA money to a Roth IRA account. Yes, you'll pay some tax now today. So you're going to pay a little more today for it, but down the road, that money is going to be tax-free. So one of the easiest things for people to do is take a look at how they're saving in their different accounts and make sure if you have a Roth to fully fund it, if you can, and if you're concerned about what you're going to pay in tax, to make sure you fully fund employer-sponsored plans or IRA accounts. If you're not sure which ones you should do, give us a call at 616-301-2581, 616-301-2581. We have some tax planning software. We can help you make that decision with some good, hard, cold facts of what might be in your best situation. But give us a call, 616-301-2581. We can help you with, should I do a Roth? Should I do more tax deferred? Should I do a little bit of each? It's important to do.
Now, Ron, I personally am a big believer in the Roth for several reasons. One, I just feel like it's easier to pay a bill out of my paycheck while I'm earning more money than it will be once I get to retirement and try to budget it out of my retirement nest egg. But two, can I go back to your scenario? And I'm going to simplify the math a little bit. If we've saved $1 into our retirement accounts and we are at a 15% tax rate, and then in retirement we may bump up if taxes go up to a 20% tax rate, there's an obvious benefit for going ahead and paying it at the 15% tax rate. But what if we're wrong, or what if we just take them at face value and believe what we've been told, that we'll be in a lower tax environment in retirement? Now, that on the surface level sounds like a good thing, but when I put away that dollar, my goal is growth. I would like that dollar to turn into $2 or $3. So even if we are in a lower tax bracket or paying a lower tax rate, if I've got more money in there than I deposited, if $1 turns into $2, even if we're in a lower tax rate, I actually owe more dollars to pay off the IRS. So if growth is your goal over time, the tax bill is growing and compounding along with your money as well. And that's something that I feel like was always missing from that conversation is, yeah, we get the value of triple compounding. You compound on the money that you would have otherwise paid on in taxes. Yes, we are in our accounts, but that amounts to a larger bill that we owe once we get to retirement.
Well, and that's true. And we don't know what taxes are going to be. We just assume they're going up. But let's take this idea, because every once in a while I hear about it, whether somebody should convert from an IRA to a Roth. Let's see what makes the most sense. So let's say two individuals have $100,000 in an IRA, okay? And let's say they're doing okay, they're doing well, and they're paying over time 30% in tax, state, local, whatever it is, 30%. So one of the arguments is that when you take money out of an IRA and you pay tax on it, you have less money to grow. Okay, so you have an IRA and you decide to convert all 100,000 in this example, and you're paying 30% tax. So all of a sudden, that IRA now is a Roth, but it only has 70,000 instead of 100. Your next door neighbor kept his $100,000 in the IRA, didn't take out, pay tax. So he's starting with 100,000, you're starting with 70,000. Now let's fast forward for 10 years. And let's just say the markets go up 10%, go up 7% a year, which is pretty good. That means it'll double. So the IRA that was not converted went from 100,000 to 200,000. The IRA that was converted started at 70. It was 100 minus 30% tax, started at 70. Now it's 140,000. So let's say taxes are still 30%. So if you take 30% out of 200,000, that's $60,000. Now you're left with 140,000, aren't you? So the argument that you're going to leave money in an IRA compounding, if you invest in the same strategy, it's a wash. The only thing that you're concerned about is 10 years from now, what if taxes go, in this example, from 30 to 40% that somebody pays? Now you're paying 40% on $200,000 in an IRA versus 0% on $140,000 in a Roth. So to make the assumption that, oh gosh, I'm going to get triple compounding and all that good stuff, if you compare apples to apples, not apples to oranges or bananas or blueberries, whatever fruit you like, it doesn't make any sense to say I'm going to be better off in a tax-deferred account if I use the exact same strategy in the tax-deferred IRA, in the exact same strategy in the Roth IRA. They're going to grow equally. It just gets to be down the road, I got tax-free money. If taxes went up, I'm going to be better off with the Roth. If for some reason what you pay in taxes went down, then that makes some sense. But most of the time when I ask folks, I say, what do you think about taxes over the next 5 years, what we pay? You think they're going to go up? You think they'll go down? You think it'll be about the same? 9 out of 10 people say, I think they're going to go up. So that's where the strategy seems to make some sense. And that's where I can do this comparison and say, yeah, maybe it does make sense to do some, at least some, into a Roth, a tax-free account.
Well, for your situation, ladies and gentlemen, you need to crunch those numbers carefully. You need to examine all of the assumptions that you are planning and saving and investing your money under, and see if you believe those assumptions will work out and hold true into the future. There are a lot of planning assumptions, traditional ways that we have been taught to save, that when we really examine them today, may not be what we still believe will hold true. And therefore, we need to maybe re-examine, reevaluate, and restructure the plan accordingly. If you need any help with that, crunching the numbers, putting the numbers side by side, quantifying what your tax bill may be if you simply defer and default to the IRS's plan, or if you are proactive and take advantage of these Roth opportunities, Ron Corser, the team there at Cornerstone Retirement Partners, can certainly crunch those numbers with you, for you, show you what that looks like. Give a call, 616-301-2581, 616-301-2581, 616-301-2581. Now, Ron, this may be a bit of a limited opportunity as well. From my understanding and the research I've done, the reading, what I've heard from others is that the proposed infrastructure bill. Now, not quite law yet, but the proposed bill actually puts a sunset or moratorium on the potential for Roth conversions in like 10 years. They're giving this one some runway time and some lead time, according to the wording of what I have seen. But still, it's not something that if we've got a large IRA, we want to convert all at once. We typically want to do that over time and probably take advantage of that 10 years. And then we also know that under current law, and this is already on the books, that tax laws and rates and brackets are changing. Now they can say, well, we didn't do this because it was put into effect some time ago. But when they put the Trump era Tax Cuts and Jobs Act initiative in place, that only was for a temporary amount of time. And in 2026, tax rates across the board essentially are going back up to the level they were in 2017.
Yeah, that's an automatic tax increase. I kind of smile when I hear about this infrastructure thing. I always thought infrastructure was bridges, roads, and stuff like that.
As did I.
That's the smallest part of the infrastructure bill. So Lord help us. People have asked me what I thought about the Roth, and I'm a big proponent as a certified financial planner and a fiduciary. I always do what's in the best interest of the client. And most of the time I tell people it's in your best interest to at least allow us to talk about the Roth conversion, the good, the bad, the ugly, all of it. So when I get down to it, they say, well, they're going to change the tax rules. And I tell people they're not going to change the tax rules on a Roth account. They're crazy, but they're not stupid down there. What I think is a possibility, and I've been saying this for a couple of years, is that they may say effective the 1st of January, for example, no more Roth accounts. If you got them right now, you can keep them. If you don't got them, you can't have another one. They may also say, we'll do something about the conversion, but my feeling is that they won't do that. Why? Because when you convert, that creates tax dollars. And they would love us all to convert all of our tax deferred accounts right now.
Well, maybe that's why they're giving us this 10-year window. They're making it feel like a limited time offer so more people do it and they get a windfall all at once.
Absolutely. But I think it's more likely they could grandfather in the Roth account. That's just my guess. But it's important that everybody, you take advantage of what's there right now. We're willing to do the heavy lifting for you, ladies and gentlemen. We're willing to do the analysis for you. It's not something you have to do. We'll present it to you in really clear black and white numbers. You can see it. It'll be as objective as possible. So if you want to know, does a Roth make sense? Does that strategy make sense? Tax-free investing, does it make sense? Give us a call at 616-301-2581 or go to our website, www.cornerstone-rp.com. Put in your name and number and we'll talk to you. Again, phone number is 616-301-2581. So let's move on to another thing that maybe doesn't impact everybody, but there are people out there, and we have clients that have health savings accounts. These are really marvelous things. They really are. So you have the ability now through the end of the year to fully max out all the benefits in your health savings account. And for example, on individuals under 50, you can put up to $3,600 in there. For families, when the plan participant is over 55, you can put up to $8,200 in there. And keep in mind, these are really neat things to have because you get a tax deduction and you get to use, if you use it properly, you get to use it tax-free. So if you have the ability to, or you have the Roth account, or not a Roth account, but a health savings account, even if you have one with your employer, you can still create one outside of your employer's plan, long as you adhere to the limits. You can actually have an HSA at a bank or someplace, even though you have an HSA with your employer. You just have to be part of a high deductible healthcare plan. So that's another place to look for savings. A third place to look for savings, maybe a little smaller, but for those of you who have flexible savings accounts, FSAs. A flexible savings account, it's really a neat account. When my wife Nancy worked at one of the bigger office furniture companies here in Grand Rapids many, many moons ago, she had one. And it's a use it or lose it, whereas a healthcare savings account, you can carry over what you haven't spent. With a flexible savings account, you have to use the dollars this year. And you can only use it for medical expenses. But, if you have an opportunity to put a little more in there this year and still use it before the end of the year, that's a good idea to do. So those are three things we've covered so far that can impact what you're going to pay in tax this year. But the last two, the health savings account and the flexible spending account, can actually impact what you do this year. So those are good things to take a look at. And it's not too early to start figuring out, can I max them out? Do I have enough money laying around to do that and to go forward on it? So give us a call at 616-301-2581, 616-301-2581. Be more than happy to help you with these things.
Again, 616-301-2581, 616-301-2581, 616-301-2581. Ron, as we're talking about daylight savings time and doing more with less, if we prepay our taxes, if we are more efficient with our taxes, if we get to keep more of our dollars, that's effectively doing more with less. So taxes, one of the largest expenses, we've talked about it, that we will face in retirement. We've got a couple other potential expenses and unknown expenses that could be pretty significant, but tax is probably our largest known expense in retirement. And we've got to be efficient. We've got to plan proactively and very carefully with the tax implications of our dollars and our savings to make the most of it, to do more with our money. And so let's be proactive, ladies and gentlemen. Take that step, give a call, set up a time to speak with the team from Cornerstone Retirement Partners. Certified financial planner Ron Corser will help communicate your tax situation with you and between your team of professionals to make sure everyone is on the same page and you are identifying each and every opportunity that you have to be as efficient as possible. 616-301-2581. That is 616-301-2581. 616-301-2581. And having your advisory team in communication, that is one of the most important things. So if you've got a tax professional that you are working with and have not had that communication with the financial professional or the legacy and estate attorney professional, that's an important step. Ron Corser has those relationships, or more than happy and willing to speak with the team that you have in place. Double checking, reviewing current plans, putting plans together, formulating them, and then helping to execute and implement them on an ongoing basis so that you can enjoy more of your time with confidence rather than having to worry and think about, are you doing the best things? Are you being smart with your money? That's the job of having that financial team there at Cornerstone Retirement Partners. Give them a call, 616-301-2581, 616-301-2581. Quick break. We'll come back. We'll talk more about saving on taxes, being smart with your money, with taxes on your course to retirement in just a moment.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
And welcome back into the program. This is your Course to Retirement, Grand Rapids resource for that common sense approach to planning, and the perspective and guidance that we need when it comes to our money is Certified Financial Planner, CFP, Ron Corser, founding partner there at Cornerstone Retirement Partners. You can find them online at cornerstone-rp.com, cornerstone-rp.com, or you can give them a call, 616-301-2581, 616-301-2581. And today we are talking about a topic that is top of mind with many savers and investors, and that is taxes. Ron, we know that there are some deadlines before the end of the year when it comes to taxes, and then we know that the filing deadline is not until a few months into the following year, and there's some window of opportunity there, but understanding the difference of what needs to be done before December 31st and what needs to be done before April 15th or whatever the date ends up being for next year is always something that creates a little bit of confusion. So we are trying to identify as many opportunities and strategies that will be beneficial for listeners or viewers to the podcast or savers and investors as possible. Another one I know is that there's a difference between long-term gains and short-term gains, and that throws a little bit more cloudiness into the water. So can you help us clarify?
Well, let's assume that this doesn't include IRA accounts or 401ks, tax deferred accounts. But for those of you who have investment accounts that hold different kinds of mutual funds, stocks and bonds and things like that, take a look at your most recent statement. This would be the one ending October, and see where you have gains and see where you have losses. So we're going to talk about as an interesting and simple concept called tax harvesting. It's something most advisors walk through their clients with it in the fourth quarter. What it simply means is take a look at those things. And these are in taxable brokerage accounts, things like that, mutual fund accounts, where you've had gains. Now, if you've held that security, that fund, whatever it is, for more than a year, and you have a gain, you can sell that. And it has a tax implication. What does that mean? You have two kinds of gains when it comes to investing in stock market-based things. You have long-term capital gains and short-term capital gains. Long-term capital gains, what's that? You bought something on the 1st of June in 2020, and you still own it. You held it for more than 365 days. If you choose to sell that and at a profit, it's a capital gain. So you bought a stock or a mutual fund at $10 a share, and the stock goes up to $12 and you sell it. And it's a long-term gain because you've held that more than a year. You've got a $2 a share capital gain. Now, capital gains are taxed differently potentially than income taxes. So depending on your income level, that gain can be taxed at 15% maximum. When you may have so much income that your real income rate is 20%. So one way to look at, did I have a gain, is does it make sense to sell it and take profits now, because I'll pay potentially a capital gain tax, which is lower than my income tax rate. Now, here's where people go, they get a kind of a mental cramp. They say, why would you want me to sell something that I'm making money on? And that's a really good question. So here's an answer, and I don't know if it's a really good answer, but when is the best time to sell something that you've invested in? When you've made a profit on it?
Yeah.
Or when you have a loss on it?
Nope. When you've got a profit, when there's money there on the table, we'll take it, right?
Yeah,
Even if you have to pay a little tax, you still end up with more than you started with.
Yeah. When is the best time to leave the casino? When you've made money or when you've lost money? So it's a tough decision for some people to make. But think about this. Even if you sold something that you made money on, all you have to do legally is wait 31 days. And you can buy that same security back with no tax consequence. Now, where does tax harvesting come into play? For those of you who have brokerage accounts or investing in other non-IRA or tax-deferred accounts, you may have a security or an investment that's lost money. So you can actually sell that. And again, if you've held that more than 365 days, that becomes a long-term capital loss. If you have it less than 365 days, it's a short-term loss. It's still a loss. So here's what's called tax harvesting, and what we do in our industry. We do it a lot with clients. Is we say, let's take a look at your whole investment portfolio that's in a taxable account. Are there some things we can sell at a profit and maybe kind of cover some of that profit by selling something that has really been a loss this year? Now, if you have taxable accounts, it's really hard to go through life without having some things that lose money. So the question is, how do you take advantage of a loss? Well, let's go back to that example. You bought a stock, a security at $10, it went up to $12, and you sold it. That's a $2 capital gain per share. Let's say you have something else you bought, it's about the same time. You bought it at $10, but now it's at $9. You sell that, you have a $1 per share loss. You can offset the gains on the stock that made money by the losses on the stock that lost money. So instead of paying a capital gains tax on $20, you only pay it, or if you bought 10 shares, $2 a share, you only pay it on half of that because the $2 profit is offset by the $1 loss. Now, you can still turn around after 31 days and buy those both back if you choose, if you really like them. It's just a situation of how do we manage our stock portfolio? How do we manage our taxes? There's nothing wrong with taking profits on something. There's nothing wrong with selling a loss on something, because you know after 31 days, you can go back and rebuy both of them. No harm, no foul, but you still get the tax gain at a lower rate than perhaps what you're paying, and you get to write off some of those gains with some losses if you experience that. So those are just some things that we can help you with. It's a conversation everybody should have with their advisor. It really is. It's an important conversation to have. Nobody likes to get hit with a big tax bill that comes as a big surprise after the first of the year when there's nothing you can do about it. So give us a call. If you've never had somebody go through the tax harvesting concept or strategy, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name in there and we'll get back to you, and we can have this most important conversation on how do you minimize taxes on investment gains or losses.
Now, if we're proactive and working with professionals and planners and are receiving education about our money, hopefully there shouldn't be a lot of surprises when it comes to taxes. But there may be a couple exceptions in there, and I want to cover maybe one or two of those in just a moment. But I do want to remind you, ladies and gentlemen, that if you would like to have these conversations and make sure that you are identifying the strategies to be as efficient as possible with your money and minimize and pay the least in taxes possible, pick up the phone, give a call. The help, the assistance of a certified financial planner is available to you just for being a listener to this program. No cost, no obligation. Ron Corser will happily chat with you, sit down, help you identify opportunities, strategize on how to take advantage, formulate that plan. 616-301-2581, 616-301-2581. Ron, the surprise that I alluded to is specifically with non-retirement investments. So non-qualified after-tax dollars. This is not your IRA. This is not your Roth. This is not your 401k. But I remember back in 2008 and 2009, after the Great Recession and the big losses that people took that year, that a lot of people were surprised that not only did they lose money in their mutual funds, but then on top of that, they received a tax bill for the movement in their mutual funds. They actually owed taxes on an investment that lost value. To me, that would be pretty surprising if I didn't understand the inner workings of how mutual funds work and operate.
Yeah, that's one of the anomalies with dealing with mutual funds. In the fourth quarter, every mutual fund has to declare the time when they're going to figure out how much that mutual fund created in terms of positive capital gains, losses in capital gains, dividend distributions, interest distributions. Those all come on what's that beautiful tax document called a 1099. It's not a 1099-R, which is just for retirement accounts that you get when you take money out. It's a 1099 that covers all the gains and losses in your particular fund, in your particular brokerage account. And it can be really frustrating because, and we're going to see it probably this year because the market has done well this year. People are going to get these additional taxes, even though they didn't sell their mutual fund. They didn't do what they did call realize that gain. It still kicked off capital gains, dividends, interest, and things like that. And sometimes it's a good idea to call the mutual fund company and find out when they're going to issue that statement. Because what you can do if you think you're going to have a big gain, you can actually try to sell that mutual fund before that date when they kick it off officially. That means you're not going to get hit with that big tax bill. And remember, you can always buy that mutual fund back after 31 days and really not miss a beat. Not that much is going to happen in a month. But it's one of those ugly things. We call it phantom income. We didn't spend the capital gain. We didn't spend the dividend. We didn't spend the interest. We didn't do anything with it. It just got rolled back over into our mutual fund. And now I got to pay taxes on it as if I had taken it all out as income and went out and bought a new refrigerator or went on a trip. It's called phantom income, and it can be a real hit in the head for some people, and they don't realize it. It's a good point.
Well, again, one of those things that caught even pretty educated, savvy investors off guard. And I hear about the inefficiencies of mutual funds. I think that is one of them, that basically the internal sales and turnover ratio inside, the number of stocks that they transact, even if you are buying and holding, that can create a gain or a loss, and sometimes one that is surprising. So again, talking with Ron Corser here, certified financial planner, about how to be efficient with your taxes, how to save money in taxes over the course of your investment life, and specifically through retirement. And if you'd like to explore any of these opportunities, pick up the phone, give a call, 616-301-2581, 616-301-2581, 616-301-2581. Are there any other proactive moves that you would encourage people to take advantage of? And specifically, Ron, any that have a deadline before the end of the year that we need to act on?
Yeah, there's a big one. It's called the charitable deduction, qualified charitable deductions, QCD. Here's what that means. For people that are over 70 and a half, if you have a required minimum distribution in your IRA, you can actually give that distribution away, that RMD away, to a qualified charity. Now,
or that new group that's got to do it at 72, right? Because both of those groups, 70 and a half under the old law, 72 under the new law, basically both of them now are still within RMD range.
Yeah. So you have the opportunity to give it away. Now, where does that come into play? We have a lot of clients that are charity minded. They do a lot of, for example, tithing to churches. I encourage people to send their qualified charitable deduction to the church if they're tithers. I kind of joke with people and say, I don't think the Lord Jesus really minds if you get a tax deduction for what you've given to the church of your choice. But what happens is you give that RMD away, you don't pay any tax on it, and yet by taking it out of your IRA, it qualifies you. That says that, okay, I've taken my required distribution, but I've given it totally to a qualified charity. And so you reduce tax. Because if you're giving money away to charities now, whether it's a church, some other qualified 501c3 company, why not take the tax deduction? I think it just makes great sense to be good stewards of your money. Now, there's also one other thing available, and this is strictly for this year, and it's called a giant qualified charitable deduction, mega charitable deduction, where you can actually liquidate an entire IRA. You can do it only for this year. So let's say you have an IRA of $1 million. You can actually give it all away to a charity. You can liquidate it, give it all to a charity. You get a tax deduction, and you don't pay any tax on it. It nets itself out. But the mega qualified charitable deduction is only available through the end of this year. So for those of you who are thinking about doing something over and above a normal qualified charitable deduction, work with somebody, a CPA. We can help you with it to figure out what's in your best interest. So I think giving away money to charity is always a good thing, particularly if you're charitable minded. And if you can get a tax break on it, it just makes even more sense. But those things have to be done by the end of this year. Now, if you give money away to a charity, if you send your required minimum distribution to them, always make sure that you get some sort of receipt. If it's going to your church, tell them it's coming. And check, if it comes to them, the check is going to be made out. You never take control of the money. The check goes to that charity. Make sure you get a copy. If you can make a copy of that check and get a receipt at least, so that when you do your tax return, you can show, because you're going to get a 1099-R showing money came out of the IRA. And you need something to prove that it went to charity. So make sure you can document what you did. And it just makes life a whole lot easier.
Having documentation makes a lot of things in life a whole lot easier, but this is one way to get money out of those retirement accounts really without ever paying tax, truly tax free. And yes, we made an agreement with the IRS when we first saved that money that we'd pay tax later. But if you reach the point where RMDs are required and you don't necessarily need the money, what a fantastic move to be able to remove the money, meet the RMD requirements, and then donate it directly to your church, your charity, your nonprofit organization of choice, your school, your alma mater, what have you, without you paying tax on it, without them having to pay tax on it. Pretty fantastic opportunity, Ron. And I know that proactive planners do take advantage of those kind of opportunities to help control, minimize the tax bill. Give a call, ladies and gentlemen, if you'd like any help or assistance with that. It's not necessarily a very difficult move, but it's one that you want to get absolutely right. All the T's crossed and I's dotted. Ron Corser can help you with that. 616-301-2581, 616-301-2581, 616-301-2581. Ron, any other proactive moves that we can be aware of or that you'd like to talk about on today's program?
Yeah, and this is a simple one for those of you who have to pay quarterly taxes. And we do. I have to pay quarterly taxes. You can always make that fourth quarter payment, which is due on January 15th, 2022. You can always make it this year. So it becomes a tax deduction this year. So that's one of the small things that for those of you who are doing quarterly taxes, you can handle that right away. I'll give you a great example. Last week, we had a client that rolled over an IRA. It was a considerable amount into a Roth. They made a decision that they didn't want to take the money out of the Roth to pay the tax. They had money sitting in a checking account. They could pay the tax. And they decided with what we did, and it was my recommendation, is to pay a quarterly tax now on it because they were paying quarterlies anyhow. So it just helped them going forward with what they have to do with their tax return for 2021. It's something you have to do by the end of the year, but it's a small thing because sometimes maybe next year you're not going to have to pay quarterlies. Who knows? So you get the deduction this year if at all possible, and it's appropriate to do it, and it's legal to do it. And the IRS will thank you, and so will the government, because you gave them tax money earlier than you had to.
Well, again, being proactive has its benefits, and this is one time when prepaying on those taxes could be beneficial for you. Again, all of these strategies are very specific and individual and really need the numbers crunched and the guidance of a professional to help you weigh the benefits and the disadvantages, the costs and the advantage of each of these moves. Give a call. Ron Corser can help you with that. 616-301-2581, 616-301-2581. And Ron, if we are considering making any large financial transaction, investing, buying, selling real estate, or buying or selling a business, transitioning business, even generationally to our children. These are all times where there can be some tax implications, and being proactive and talking about that transaction and our intentions ahead of actually making the transaction can really be beneficial in many, many cases.
You know, it really can, and I encourage everybody to do that because we do it in our own situation, my wife Nancy and I. We do what's called tax forward planning, where we meet with our CPA 3 times a year. And basically, it's a situation. This is what we're thinking about doing. This is what we're going to do. What's the tax implication of it? Is it the best way to deal with whatever it is we're dealing with? I always encourage people, for those of you who don't do your own taxes, make your tax person work for you. Pay them a little bit of extra money to do some tax forward planning. You know, if you're going to do a Roth conversion this year, go to your tax person, tell him what you want to do, ask him to do a pretend or a pro forma tax return to see what it's really going to cost you. These guys will love you. I mean, you're going to pay them an extra fee to do it, and it's worth it to do that. I mean, these guys know taxes and they know your tax return. So it's not a situation of saying, because what normally happens, we go to our tax person with a brown paper bag filled with everything and say, here's my tax stuff, make it go. And they tell us what happened in the previous year. They don't tell us what we should have done or could have done in the current year. So make your tax person work for you. For those of you who do your own taxes with TurboTax or whatever, start to play with the returns. Assume that this year's return is going to kind of be about the same as last year. So if you're going to do a Roth conversion, well, what happens if I do $10,000? That's extra taxable income. What happens to my tax return? What happens if I do 50 or 100? You can actually take a look and do, what I call a pretend tax return to see what the real dollars and cents implication is of what you're thinking about doing, so you're not surprised. It makes great sense to do it. Corporations do it. The wealthy people do it. Everybody should do it, unless you have a really simple return and you're not going to make any changes. But anytime you're going to do anything with tax harvesting, with doing Roth conversions, with putting more money into a 401k plan, if at the end of the year you're going to dump a whole bunch more money in, what's that going to do to your tax return? Those are things you need to know. Use your tax preparer. He's a professional. She's a professional. They'll love you if you pay them a little extra to get the information you need to make great decisions. It makes really good sense, and it's money well spent.
If you have to pay a couple $100 in order to save and just an extra 1, 2, 3, 5% on your retirement nest egg, I certainly think that cost benefit would be well worth it. So give a call, ladies and gentlemen. Ron Corser, a certified financial planner, his team of planning professionals here as your resource at Cornerstone Retirement Partners. They will work with your tax professional, or they have some that they already have those kind of relationships with that can help lead and guide you in the right direction. Crunch the numbers ahead of time. 616-301-2581, 616-301-2581. If I can give an analogy for that, Ron, a home builder doesn't just wing it. They don't show up with lumber and plywood and hammers and nails and say, we're going to get to work here. Let's start putting this thing together without a plan. And they have a blueprint, just like that dry run should be your blueprint for putting together and executing, building your financial structure and how to put everything, all of the pieces in the right place.
That's a great analogy. What I encourage people, and I see it every year, what happens? We get into the tax season. It gets to be February. People start looking for the 1099-Rs and 1099s so they can get their taxes done, get their refund, but start to do it. And invariably, some people get really panic-stricken because they can't find receipts. They can't find documentation of something they did. And it really becomes stressful. And we get these. I understand it. We try to help people. Sometimes it's difficult for us to do it on a last minute basis. But what I encourage people to do is take an hour out of the time between now and, say, the middle of December, and just make sure that you have tax documentation of things that you've done in your investment accounts. If you've taken money out of your 401k or IRA, you should have a tax document that says you took it out. Now, that's not the 1099-R or something, but you should have a document that says I did it. If you've taken money out of your investment accounts, you're not going to get all of the information, but you need to have some sort of documentation that shows you did it. If you give money away to a charity, make sure you have documentation that shows you did it. Because I'll tell you, we had one client that waited and then gave some money away, and I thought they had documented it all, but they hadn't. This was 2018. About 2 months ago, they got a love letter from the IRS saying, you owe us a bunch of money. And so it took about 2 months to recreate what happened, because you just can't go back to some charities and say, I need a receipt for this thing. It took a long time to do it. So this is a great time to begin, as my uncle from Kentucky said, to begin to commence to start to get on with putting your documents together. So it's not a crash and a burn, on the 14th of April when you're looking for everything so you can file your taxes on time, or you still have to file even if you get an extension. So that's a great piece of advice. Start to do a little bit of that right now. If you bought an asset, you just got to have some of that documentation so you don't get blindsided and try to do something on the 14th of April. That's a really frustrating time.
Well, on this program, we've shared some ideas to help you save more money, to help do more with the money that you have, to help keep more of your money, in being proactive with your tax planning and preparing. We continue to move through uncertain times, so doing as much as possible with the dollars that we have is that much more important. And Ron Corser, a certified financial planner, a CFP, there as a resource for you, ladies and gentlemen. Pick up the phone, give a call. They're there to help and assist. 616-301-2581, 616-301-2581 to reach Cornerstone Retirement Partners. You can go online, cornerstone-rp.com, cornerstone-rp.com. Ron, always appreciate the guidance and perspective that you provide, the help and the assistance that you give to Grand Rapids area savers and investors.
Just remember, ladies and gentlemen, you're required to pay taxes, but you are not required to pay more than you legally have to. So do the good job of proactively planning, get the best opportunity to minimize what you have to maximize your long-term financial future. Thank you for listening to today's program. Have a blessed Sunday, and we'll talk to you soon.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.